Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tilray Brands, Inc. quarterly report. Tilray Brands, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Tilray Brands, Inc. trades at a lower price-to-book ratio of 0.64 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Tilray Brands, Inc. offers a diverse range of products and services across various segments. The company's product portfolio includes medical and adult-use cannabis products, pharmaceutical and wellness products, beverage products, and hemp-based food products. These products are sold under numerous brands such as Tilray, Afria, Broken Coast, and others. The company operates through 4 main segments: beverage, cannabis, distribution, and wellness. In addition to product sales, Tilray Brands also provides entertainment products. Its distribution network extends globally, with products being sold to retailers, wholesalers, patients, physicians, hospitals, pharmacies, researchers, and governments, as well as directly to consumers. Tilray Brands' extensive brand portfolio includes over 20 beverage brands such as Montauk Brewing, Shock Top, and Breckenridge Brewery. The company also offers a range of cannabis products under various brands like Tilray Medical, Bake Sale, and HEXO. Furthermore, it distributes pharmaceutical and wellness products through its distribution segment. Overall, Tilray Brands' business encompasses a wide array of products and services across the beverage, cannabis, distribution, and wellness segments. The stock price of Tilray Brands, Inc. (TLRY) has dropped significantly over the past year, with a decline of over 25.77% from January 2025 to January 2026. This downturn can be attributed to several key factors. One major contributor was the company's challenging financial results, particularly in its Q3 and Q4 fiscal 2025 earnings reports. Tilray reported net revenue decreases, widened losses, and adjusted EPS fell by 50% year-over-year. The cannabis segment was particularly affected, with delays in international medical permits and a strategic withdrawal from lower-yield categories contributing to the decline. Another significant factor was the lack of progress on U.S. federal marijuana legalization, which has been a major drag on cannabis stocks throughout the period. Regulatory hurdles, evolving consumer trends, integration challenges, and oversupply risks have also impeded revenue growth and compressed margins across Tilray's international operations. Additionally, cautious analyst sentiment and technical indicators played a role in the stock price decline. Some analysts issued sell or hold ratings due to concerns about margin pressures and potential volatility, while bearish moving average trends were noted in early January 2026. The company's beverage segment also faced headwinds in the U.S. craft beer market, despite diversification efforts. While there were periods of positive movement, such as an increase in share price in August and December 2025, due to anticipation of cannabis reclassification in the U.S., these developments were not enough to offset the overall downward trend during the past year. Overall, the combination of challenging financial results, industry-wide headwinds, and cautious market sentiment has contributed to Tilray's stock price decline over the past year. The primary drivers of revenue growth or decline can be identified in the company's performance. On the growth side, several factors contribute to increased revenue. The acquisition of craft beverage business portfolio II and expansion into new categories such as superseeds, better-for-you breakfast, snacking, and natural energy drinks have been significant contributors. Additionally, the company's participation in growing markets like hemp protein and hemp oil, as well as its Canadian adult-use cannabis segment, have shown promising results. The growth of branded business across brick-and-mortar retail and e-commerce has also played a crucial role in driving revenue upwards. Furthermore, the expansion into emerging medical markets and receipt of previously backlogged permits have contributed to international cannabis revenue growth. On the other hand, several factors have led to revenue decline. The discontinuation of certain SKUs and category challenges within the craft beer segment have resulted in reduced revenue. Competitive pressures and portfolio optimization efforts, including SKU rationalization and margin-focused initiatives, have also had a negative impact on revenue. Additionally, uninsured patient attrition to adult-use recreational market in Canadian medical cannabis has led to a decline in wholesale cannabis revenue. It is worth noting that certain factors have had no significant impact on revenue. Tariffs are not expected to affect the company's revenue, and U.S. federal regulatory developments regarding cannabis rescheduling may present long-term growth opportunities, but do not currently have a significant impact. The net income for the company has remained relatively unchanged over the past 3 months and 6 months. Despite this stability, the company reported a net loss during both periods. The lack of explicit information on profit margins makes it difficult to determine their exact change. However, it is inferred that various factors such as changes in fair value of warrants and foreign exchange rates may have impacted them. The expected improvement in profit margins can be attributed to ongoing efforts under Project 420. This initiative aims to optimize stock-keeping units, SKU, rationalize geographic presence, streamline distributor networks, and maximize synergies. These strategic moves are likely to contribute positively to the company's bottom line, ultimately leading to improved profitability. The company's financial performance has shown an improvement in generating positive operating cash flow. For the 6 months ending November 30, 2025, the company achieved a significant increase in its net change of operating cash flow, with a positive result compared to the previous year's negative figure. This indicates that the company is now able to generate sufficient funds from its operations to cover its expenses and investments, marking a positive shift in its financial health. The company's debt level and interest expenses have undergone significant changes. Notably, the principal amount outstanding has decreased, indicating a reduction in overall debt. However, this decrease is somewhat offset by an increase in interest expense, suggesting that while the total debt may be lower, the cost of servicing it remains high. Furthermore, the operating lines of credit for CC Pharma GmbH have increased by €113, which could indicate a need for additional short-term financing. The long-term debt has also fluctuated, with a decrease from May 31, 2025 to November 30, 2025. Restructuring charges have been incurred in both the 3 and 6 months ended November 30, 2025, suggesting that the company is actively addressing its financial obligations. Overall, while there are some positive signs of debt reduction, the increase in interest expense and operating lines of credit suggests that the company's financial situation remains complex. The company's performance can be broken down into well-performing and poorly performing segments or regions. On the positive side, Germany, Portugal, and Luxembourg were among the top-performing regions. In terms of specific markets, the medical cannabis market in Europe and the whiskey segment showed significant growth. The Canadian adult-use cannabis market also experienced a 6-10% increase on a constant currency basis, while international cannabis revenue saw an even more impressive surge of 36-24%. The company's cannabis, distribution, and wellness segments all reported increased gross margins. These positive trends suggest that the company is making strides in certain key areas. On the other hand, some regions and segments underperformed. Canadian medical cannabis saw a decline of 8-9%, while wholesale cannabis experienced a significant drop of 20-45%. The beverage segment also reported decreased gross margin. These poor performances indicate areas where the company needs to focus on improvement. Management is projecting a positive outlook for the company's growth in various areas. The spirits segment is expected to experience sustained growth, while the cannabis industry is anticipated to continue gaining traction in Europe despite economic challenges and political uncertainty. To achieve this growth, the company plans to expand through organic growth and strategic acquisitions that focus on value-added innovation within natural and organic food and beverages. The implementation of Project 420 will support the growth of acquired brands and improve profitability. Management is also optimistic about expanding into new geographic markets and product categories. In addition, the company aims to leverage its expertise to responsibly enter the U.S. market with medical-grade cannabis products. With a strong financial position, management believes that existing cash and cash generated by operations will be sufficient to meet both short-term and long-term capital needs. Overall, the company's strategy is centered around strategic growth, innovation, and responsible expansion into new markets. The company's financial history reveals a commitment to shareholder value. One notable aspect of this commitment is its practice of paying dividends. This decision demonstrates the company's confidence in its financial stability and ability to distribute profits to its investors. By doing so, the company acknowledges the importance of rewarding shareholders for their investment and trust in the organization. That concludes the financial summary for Tilray Brands, Inc. Feel free to comment below, and I will be happy to answer them when possible.